The topic for today is the instruments of money market. When we talk about the financial market, we can divide it into two subparts. The first is the capital market. Capital market is the market for long-term investments. If you want to invest a certain amount of money for a period of more than 1 year, then you are dealing with the capital market. Money market is the market for short-term investments. When you want to invest for a period of less than 1 year, we are dealing in money market. The topic today which will be discussed will be the instruments which come under the money market. Let us talk about money market basic features. It is a market for short-term funds. It has to be very clear in your mind that when we are talking about long-term investments or long-term funds, we don't deal with money market. That comes under the area of capital market. Short-term funds means money market. The maturity period is up to 1 year. Whatever instruments I will be discussing today, all of them, they will be having the maturity period, the redemption period up to 1 year. It can be less than 1 year, but the maximum limit settled is 1 year, not beyond that. The debt instruments with the maturity period of 1 year come under the coverage of money market. It is considered as a source of finance for working capital. Now, you know the capital is distinguished as working and fixed. Now, when we talk about the fixed capital, we talk about the land and the buildings, the machines, the big infrastructure. For that, you need lot of money and the maturity period of long term. That is called a long-term investment. But in the money market, when you want finance for your working capital, we talk about the money market, right? It includes the lending and borrowing of cash for a short period of time. Obviously, working capital requirements are comparatively lesser than the fixed capital requirements. So, again, short period of time borrowing and lending of cash. Money market includes sale and purchase of securities up to 1 year. This will stand with all the instruments of money market, that each and every security you are buying or selling, this can happen in money market, but the ultimate is 1 year. The securities, they get paid back or redeemed, one and the same thing, within a year. See, when I say within a year, that means short-term funds, they are easily convertible to cash. You know, when you invest in long-term securities and you talk about the liquidity, they are not liquid. Long-term investments are not liquid. So if I go in a bank and deposit money in a fixed deposit for a period of 5 years, right? And something happens that I need cash before 5 years. Will it be easily convertible to cash? No, because that is a long-term investment. So all the instruments we'll be discussing today, they will be easily convertible to cash because they are securities up to 1 year and they are highly liquid. Now see, there is no fixed geographical location of the money market. Like we talk about, there is a room or there is a sabzi mandi or there is a school, there's a fixed location, right? But money market, there is no fixed geographical location for the same. All the instruments in money market, they are close substitutes of money. This is in repetition to the line that they are highly liquid. Close substitutes of money means you can easily convert it into cash. There is no lamba chauda work for that. No long-term transaction has to be. You can easily convert them into cash. So we consider it as close substitute of money. Now talking about the institutes which deal in the money market are the Reserve Bank of India, the commercial banks, LIC, GIC, UTI, all these deal in the money market. So these institutes, again, short-term debts. When we talk about the word money market, it will be all short-term debts. These short-term debts, these institutes, and which the instruments I'll be talking about in the coming slides, they are dealt on telephone or internet. So this is the base of these instruments. Generally, on the telephone or on the internet, you can invest and you can sell your money market instruments. See, let me give you an example. Mr. K, he has say 20 lakh rupees. Now, how he got that money? It is his money. This money, 20 lakh, is lying idle for him for 6 months. He needs this money for a particular cause after 7 months. So for 6 months, he can put this money in his Almira locker and go to sleep for 6 months, or he wants to invest it. Obviously, in today's day, when the cost of living is going so high, who would like to keep that money, 20 lakh, in Almira, which will not give you any interest, which will not give you any repayment? So he wants to invest it. But the condition here is that just for 6 months, because he wants it after, in the seventh month, he wants that money back. Now the question arises, what shall he do with this 20 lakhs? Should he invest in land and building? If he does so, after 6 months, will it be easily convertible to cash? No, it won't be. Say he purchases a land for 20 lakh rupees. When he needs money in the seventh month, it will be such a huge task for him to get that money convertible to cash, to sell that land, to find a buyer of that land, and obviously he wants to sell it at a profit. So it will be a very difficult and huge task for him to convert that land money into cash. So what will he do? He should invest in the money market. It will save him of all the hassles of investing in land and building, because the money market instruments, they are easily convertible into cash. There is no hassle for selling them, and so his both works will be got into. He will be getting the interest, he will be getting some profit on his investment also, and the idle money which was lying for 6 months, he has invested. So this is the advantage of money market, that you can get it easily, liquidity, high liquidity, and it is a close substitute of money. I hope I have explained the characteristics, the basics of money market. Now coming over to the instruments. These are the instruments. The first one is the call money, the treasury bills, also called the T-bills, commercial bills, commercial paper, and the certificate of deposit. The first thing I like to tell here, that please don't get confused in these terms. See, here also I'm using the word commercial, here also I'm using the word commercial, but this doesn't mean that they are the same terms. There's a lot of difference. I'll be discussing them one by one. Let's begin. The first is the call money. What is the call money? It is the market over the telephone. Just as I told you in the previous slide, money market instruments are generally dealt in on the telephone or on the internet. So the first instrument, call money, is a market over the telephone. It is generally bank which use the call money. Now take an example of this bank. This bank faces temporary shortage of cash. People like you and me also face temporary shortage of cash, right? Many a times you need 5,000 rupees and you don't have it. So what do? You ask your friend to give it to you, and okay, I'll return it to you the very next day. So this keeps on happening amongst the friends, right? Similarly, banks also sometimes, I use the word sometimes, not always, they face temporary shortage of cash. Like it is not the shortage is not long term. Oh my God, they're devoid of money for a year. No, it's a very small phase when they have the shortage of cash. What do? They call the other bank. So they make a telephone to the other bank, calls the bank who has the surplus cash. Like the way you call the friend who has surplus cash and who will come for you in need, similarly, the bank also calls the other bank who has the surplus cash. Now, this bank will lend the money to the bank who needs money, right? So, this is how it works. A friend in need is a friend in need. So, here the same applies to the banks. One bank wants money, it takes from the other bank. Money arranged on call. So the call money is basically money arranged on a call. This is repayable on demand. Now when this bank wants his money back, he can ask for it. It is under no obligation that, oh my God, I have rented it, I have given it to the other bank, I cannot ask again. No, it is very well repayable on demand. As in when this bank needs the money back, he can call back the previous bank to pay him back. Are you getting the point? See, this bank needed money, called this bank for the shortage of cash. Now, when the lender bank wants the money, it can equally call the previous bank to pay him back. Clear? Again, the call the bank to return the money. So this is the money repayable on demand. It is a transaction which happens between two banks. Now, here comes the statement. It's an important instrument of money market. It is called the interbank transaction. You know how inter-school debates, inter-school competition is the competition between two schools, right? International is between two nations. So here we talk about interbank, means transaction between two banks. Mostly banks are the institutes who use call money. The money borrowed or lent on demand for a short period, generally one day. As I told you, it's a temporary shortage of cash. So that temporary shortage rests for generally a day. Sundays and other holidays are excluded for this purpose. So if Sunday falls in between, we will not be counting it. Also named as interbank call money market, because it is generally between the two banks, so another name can be held as interbank call money market. The maturity period of the call money is extremely short and varies from 1 day to 15 days. Okay, minimum 1 day and the maximum to maximum 15 days, not beyond that. Because the shortage of cash is generally speedily built up by that bank. So most to most 15 days. And the liquidity of call money is just next to cash. It's equivalent to cash because the lender bank can anytime call the bank and ask for the money back. So it's highly liquid. Interbank transaction. One bank needs money, he calls the other bank, and the temporary shortage of cash is filled up. Clear? Now, the question arises, why do the banks need money? Okay, if me and you need money, we have so many expenditures, right? But banks, they are the warehouse. They are the, the godowns of money. Why do they need money is the question. Banks have to maintain CRR and SLR. Now, what is this cash reserve ratio and the statutory liquidity ratio? We have made a separate video for the same. You can please go and have a look. They have to maintain this cash reserve ratio and the statutory liquidity ratio, minimum reserves they have to keep, which is made mandatory by the Reserve Bank of India. Each scheduled commercial bank has to maintain this ratio. Yeah, you can just go and check these videos of CRR and SLR. Now, if the banks do not maintain this ratio reserve, the CRR and the SLR, then the RBI generally gives a notice to the concerned bank and it will be highlighted. You have to, all the scheduled commercial banks, just as I told you, they have to maintain this cash. Sometimes the banks fall short of funds to upkeep this reserve. Many a times they fall short of funds, the cash gets little less to maintain this reserve. So it calls the other bank for help. So here the need for money arises. Right? Supposingly, I tell you or your mother tells you that you have to maintain this 500 cash all the times in your Almira. Whatever happens, how much expenditure goes high, this 500 you have to keep in your Almira all the time. Sometimes you just have 400 rupees and the mother's yelling is there on you that you have to keep 500. So what will you do? You will ask your friend to lend 100 rupees to you so that you upkeep that 500 and keep it back. The next day you'll return, right? So this is what happens to the bank also. The RBI, the mother bank, it tells the scheduled commercial banks to maintain that ratio. 500 in the example. Here, it may be higher, cash reserve ratio and the statutory liquidity ratio. If sometimes the bank falls short of that money, of that reserve ratio, so they need money. They call other banks for help and this is what is called the call money. The borrower bank shall return the money in short period initially agreed at the time of borrow of the day. So when the borrower bank asks for money, he generally specifies that within this stipulated 1 day or 2 day, I will return your money back. So the borrower bank very efficiently, very honestly returns the money back. Okay, clear? Now next question is the interest paid on the call money? Yes, it is paid. Call money is like a short-term loan, very short-term loan. The interest rate paid on the call money is called call rate. So it is understood that the lender bank will earn rate of interest from the borrower bank, and this rate is called the call rate. Call rate is a very volatile rate which may vary from day to day and sometimes from hour to hour. This rate of interest on the call money keeps on changing. Not only on the daily basis, also it changes on the hourly basis, is a very high volatile rate. It does not remain fixed. Now, what are the repercussions in the market when the call rate rises or falls? Just listen very carefully. A rise in the call rate makes other sources of finance cheaper for the banks. Now, what are the other sources of finance? It is the commercial paper and the certificate of deposit. I will be discussing them in the slides to follow in this very video. Now, if the call rate, if this interest rate on the call money rises, okay, so this call rate is rising, what will happen? The other sources of finance will become cheaper for the banks because call money will become expensive. So they will resort to other sources of finance to fill in that shortage of money to maintain the CRR and the SLR. Why will they shift to other sources of finance? Because the call rate rises, the interest rate on the call money rises. Banks may resort to other sources of finance to raise funds. Hence, an inverse relationship between the rate of interest on the call money and other securities take place. When the rate of interest on the call money increases, other securities become cheap. It is very simple. If you have two options, options A and option B, if option A becomes expensive, automatically option B will become cheap. Same is what is happening here. When the interest on the call money will rise, other securities, they become cheap and the banks resort to other sources of finance. Organizations other than banks, like insurance companies and the mutual funds, they also deal with call money. It's not only the banks, but insurance companies and mutual funds also deal with the call money, but basically this call money is assorted to banks. That is why it is named interbank transaction, interbank call money. Clear? Next comes the second instrument of money market, which is called the treasury bills. Treasury bills, another name is T-bills. Now, what is the meaning of the word treasure? Right? Treasure means khazana, the built up money, the accumulated money. So who has that treasure? It's the government, not people like you and me. We don't have that treasure, the government has the treasure. Let's come to the point. Sometimes the government too need funds. You and me, like you and me, like we common people, we need funds. Similarly, the government also needs funds. Now, from where it will borrow? From whom will the government borrow? Again, it will borrow from the citizens like you and me, because accumulated, when we all give the money, it will be a huge amount. So sometimes the government needs funds and it borrows from citizens. This is why treasury bills come into force. Treasury bills are issued by the Reserve Bank of India on the behalf of Government of India. Now, if Government of India needs funds, Government of India doesn't come up to issue treasury bills. It is the Reserve Bank of India who is authorized to issue T-bills on behalf of Government of India. It's a very important concept. Please understand. It is issued in the name of the Government of India, but not issued by Government of India itself. It is issued by the Reserve Bank of India in the name of the Government of India. Treasury bills allow the government to get short-term borrowings. Again, because it is money market, because it's an instrument of money market, it has to be short-term borrowing, all the instruments discussed today. These bills are sold to the banks and to the general public. The banks can also purchase them, and of course, we people can also purchase the treasury bills. Clear? Next, these are negotiable instruments and they're freely transferable. You have the treasury bills, you can give it to me. I have it, I can give it to you. So they are negotiable instruments. They are freely transferable. If they are issued in my name, it doesn't mean that I have to be having it. I can give it to you, no worries. The main thing in the treasury bills is the safest investment. It's very safe. Why? Because it is issued by the RBI. है ना? If supposingly I start issuing or you start issuing treasury bills, the security will be doubtful. There will be a very big question mark. But there is no question mark in the treasury bills because they are issued by whom? By the Reserve Bank of India, the Apex Bank, on the behalf of Government of India. So that is why it is considered the safest investment. There is zero default in repayment because of Government of India is there. If Government of India only defaults, then where will the other people go? So the treasury bills are the most safe investments. They are zero default in repayment, okay, because the government acts as the surety. The maturity period of the treasury bill varies from 14 to 364 days. At the most 1 year, and the minimum is 14 days. Now, treasury bills, they're also called zero coupon bonds. Very important. MCQs can be asked for the same. Zero coupon bonds. Another drastic feature here is they are issued at a price lower than the face value and repaid at par. Are you getting it? Face value, say less. It is issued at a price lower than the face value. Let me give you an example. Mr. A purchases a 3-month treasury bill with a face value of 1 lakh for 90,000. So this is what I mean to say when I say that if they are issued lower than the face value. What is the face value in this case? It's 1 lakh. And how much is it being sold for? 90,000. So you will have to pay 90,000 rupees to get a treasury bill for 1 lakh. On the maturity date, Mr. A will get 1 lakh. So this is when what I say repaid at par. It is repaid at 1 lakh, but it was issued at 90,000. Now the difference between the bill amount and the amount paid to purchase the bill is the interest which he receives. So in this case, 1 lakh minus 90,000, which comes out to be 10,000 rupees. Mr. A will be earning 10,000 for the 3-month treasury bill. Now, I hope this line is clear to you that they are issued at a price lower than the face value. Here, the face value is 1 lakh and it was issued for 90,000 and it is repaid at 1 lakh. Simple. Now, they are available for a minimum amount of 25,000 and its multiples thereof. For how much are they issued? They are issued for say 25,000, 50,000, 75,000, 1 lakh, and that is way how is it issued. Minimum of 25,000 and its multiples. Clear? Now the third instrument of money market comes out to be commercial bills. They are very common instruments used in the credit purchase and sale of goods. So almost a little similar to the bills of exchange. They have short-term maturity period, generally 90 days. They are negotiable instruments. They are transferred easily. Okay. Now let's come to the point. What is commercial bills? They are called the trade bills or the accommodation bills, which are drawn by one business firm on another. This line will be made very clear with this example. See, supposingly Mr. X supplies goods to Y. So they are in trade. Mr. X supplies goods to Y and Mr. Y pays the money in cash. Over. Again Mr. X supplies goods to Y and Mr. Y pays the cash. Over. Y is supposed to pay cash to X. This is how the trade is dealt with. Let us take an example. Say that Y does not have hard cash. X supplied goods to Y, but Y does not have cash to pay to X. Now what will Y do? Y, which will be called the drawee in our example, accepts a bill in favor of X, who will be called the drawer, stating that Y shall pay the specified sum on the specified date to X. So what does that bill looks like? It will be such type of an instrument, this type of a paper, okay, which will be signed by Y. Y will be called the drawee. It will be signed by Y and stated that, okay, I have to pay so and so amount to Mr. X. In this much period of time, I shall pay. I have to pay, but I don't have cash. say in a period of 3 months or in a period of 4 months, I shall definitely pay it to X. So this is what, this is an example which I'm just giving it to you, that this bills of exchange looks like this. Now, instead of paying cash to Mr. X, Y will give this bill of exchange to X. X will keep it with him. Okay, and after on the maturity date, it shall present it to Y and get the cash back. Is it clear? Now, this bill, when accepted by Y, becomes a trade bill and it is a marketable instrument. Right? So, Mr. X can keep it with him if it wants to keep it for that stipulated time, or it can transfer it to somebody else. It can give it to somebody else. It can keep on passing. Is it clear? It will be called a trade bill and it becomes a marketable instrument. A trade bill is a written acknowledgement of debt. Who acknowledged in this case? Y acknowledged it. Y wrote it now that I have to pay. So Y written acknowledgement of debt. And on accepting the bill means Y will sign it. The drawee Y becomes liable to make the payment on the due date. Okay, if the bill is with X on the due date, Y will pay it to X. If X has transferred it to say Z, to A, to B, to whomsoever, then Y will pay it to the person who is having it. Clear? Now these bills can be discounted with the bank even before the maturity period. If X needs money immediately, he can go to the bank and get it discounted. So what will happen is X will give this bill to bank, right? And bank will immediately pay it to X. So X does not have to wait for the maturity period. If the bill is drawn for 3 months, X did not have to wait for 3 months. X will go to the bank and bank will pay the money immediately to X. The bank will keep the money for 3 months or for the stipulated time period. Again, it will go to Y and then Y will make the payment to the bank. So, bank acts as an intermediary for X person because X wanted cash, but he did not have to wait for 3 months for the bill to get matured. X will immediately go to the bank. Bank will rediscount the bill. Obviously, bank will keep a little commission. Got it? Now, the drawer of the bill, who is X in this case, or the maker, instructs or directs the payee or the drawee to make the payment within a fixed period of time. The drawee accepts the bill and becomes liable to make the payment on the due date. It's very well similar to the bills of exchange. I hope you've done that chapter. Now, the fourth point comes is the commercial paper. This is the next instrument. It just similar to the previous one, the commercial word is the same in both the cases, but it is a different instrument. So please listen very carefully. Commercial paper was introduced in India for the first time in the year 1990. The commercial paper is an unsecured promissory note, but it is unsecured promissory note. Please mark the words, right? Now see, Mr. A borrowed certain sum of money from Mr. B. In return, Mr. A writes a promissory note that he shall pay particular sum on the particular day. Mr. A duly signs it. But, my dear, this involves high degree of risk. What if he defaults? You don't know Mr. A, I don't know Mr. A. Hannah, maybe he just ends up landing on default. What will happen? So, because these commercial papers are unsecured, I told you in the very first line they are unsecured. So, these can be issued by the companies having good reputation and credit worthiness. So, coming to the point, the commercial papers, they are issued by the companies. They are not issued by citizens because they are unsecured. Not issued by me and you. Clear? Whom are they issued by? They are issued by the companies who are having very good reputation and they are having high credit worthiness. The commercial banks and the mutual funds are the main investors of commercial papers. Right? Who issues them? The commercial banks and the mutual funds. Commercial papers are issued by the public or the private sector companies with a fixed maturity period which varies from 15 days to 1 year. So because they are issued by credit-worthy companies, so the doubtfulness becomes to zero. If common citizens also start issuing this commercial paper, it will be a very high degree of risk. Okay, so what is a commercial paper? It's an unsecured promissory note issued by credit-worthy companies having good reputation. What is the main purpose of issuing commercial paper? See, please remember, it's just issued by credit-worthy companies. They issue commercial papers because they want to meet the flotation costs. What is the flotation cost? Funds raised by commercial papers, they are often used to meet the flotation costs. This process is called bridge financing. Now, this is another term. Kindly note it down. You can be very well asked in the paper and especially in the MCQs. First of all, what is bridge financing? The system, the process in which the commercial papers are issued to meet the flotation cost, that is called bridge financing. Like you use a bridge to move from one place to the other. Similarly, to meet these flotation costs, commercial papers are issued. Please learn, credit-worthy companies on the one hand, one word, and the second term is bridge financing. Now comes what is the term flotation costs. Let's come to the point. Let us say that the company wants to raise long-term funds to invest in the infrastructure of a new branch and to buy land, building and machinery. Now, you also know that companies, they are always in need of funds, and a company wants to raise funds, bigger amount for the infrastructure of a new branch or to invest in land, building and machinery. Now, to arrange these long-term funds, they have, what will they do? They will issue shares, they will issue debentures. This is how they get money, right? The company will have to incur flotation costs like the brokerage. When you issue shares and debentures, have you read that chapter? You have to pay the brokerage. You have to pay the commission and the printing of prospectus. Okay, now what's a prospectus? It is a detailed version of the company which shows that this is the credit worthiness of the company, this is the future prospects of the company, this is how the company is going to trade, and so it asks the people to come and invest in their share capital. That book is called prospectus. Now they have to incur costs. है ना? Which type of costs I told you? They have to pay brokerage, they have to pay the commission and the printing of the prospectus. These are called flotation costs. है ना? Now these flotation costs, they are met by the issue of commercial papers. Please don't get confused. Commercial papers have nothing to do with this. They don't have anything to do with long-term funds. Na, 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 na. To raise the long-term funds, the costs will be incurred. Which costs? These costs. The flotation costs are incurred to raise the long-term funds. And to meet these flotation costs, we cover up with the issuing of commercial paper. Is it clear? Now, I was discussing that what is the main purpose of issuing commercial papers. A, the flotation costs, I've explained you in the detail, and the second is the short-term funds for seasonal and working capital. So, the credit-worthy companies, they issue commercial papers not only to meet the flotation costs, they may also issue these commercial papers to collect the short-term funds for the seasonal and the working capital. Make it very clear that money market instruments will be catering to only working capital, not the fixed capital. Okay. Next, the fifth instrument I'll be talking about is the certificate of deposit, CD. Right? You've heard of FD, fixed deposit. Similarly, there is another term, CD, which is the certificate of deposit. Now, if we come to the main function of bank, what does the bank do? This is a person who is having extra money, and this is a person who is facing shortage of money and he wants loan. So the bank acts as intermediary. This person will deposit the money in the bank, and the same money the bank will lend it out to this man. है ना? So this is how the circle goes on, and this is what is the purpose of the bank. Now, Similarly, the banks issue certificate of deposit. As I told you, they also issue fixed deposits, FD. It's a very common term, FD. And they also issue certificate of deposit. I am mentioning it so that it's very easy for you to memorize. What is CD? It's a time deposit which can be very well sold in the secondary market. See, such a nice statement. It's a time deposit. What does this mean? That for a particular period of time, you'll deposit the money in the bank. And see, the second advantage is it is sold in the secondary market. You can sell that CD. If you have deposited that money, you can sell it to me. I can further sell it to somebody else. That is called secondary market. You know now what is primary market in the secondary market? I have made separate video for primary and secondary market. Kindly go and have a look on that video. So certificate of deposit is a time deposit which is sold in the secondary market. It's a bearer certificate or document of title. Right? Whosoever is holding it is his. It's a negotiable instrument. It can be transferred very easily. See, if Mr. X has purchased it from the bank, he can give it to Mr. Y. Further, it can be passed on to Mr. Z. It can very well come back to Mr. X. So the circle can go on and on. Clear? Now, supposingly you have a bank account in the bank or you have an FD in the bank. If it is in your name, it will stick to your name till it matures. If the maturity period is 5 years or 4 years, it will be in your name, so it will be in your name. But it is not the case with the certificate of deposit we are talking about. If it is issued in the name of my X, it can be transferred to Y, which can be further transferred to X, and it can again come back to X. This is what I mean to say. It's a bearer certificate or the document of title. Now, CD is issued by banks against the deposits kept by the companies and institutions. You know what this line mean? Companies and the institutions, they deposit the extra money in the bank, and for that deposit only, the bank will issue the CD. To whom? Banks issue CD to individuals, to corporations, and to the companies. Whosoever wants to get it, you can get it. No worries. Generally, these CDs are issued during the period of tight liquidity when the deposit growth of the bank is slow and the demand for credit is high. The deposit growth of the bank is slow. So what does this mean? This means not many people are coming forward to deposit the money in the bank. Not many people are coming forward. But they want credit. Many people want credit. There is shortage of cash. So that is why people will not go to the bank to deposit. They will go to the bank to ask for more and more loans. So what do the banks do? Then they issue CDs. They invite people, come on, deposit the money with me. When they need deposits, at that moment, these CDs are issued. Bank needs depositors to issue loans. Where will it issue loans from? Somebody has to come and deposit. Somebody has to fill the treasure of the bank. Now, only then it will issue. Tabhi to it will give it to other people. So why? How will it give? So this is how, by issuing the certificate of deposit, it is inviting depositors to come and deposit money so that it is easy for the banks to issue loans. If the depositors are less, if people, this is what I said, na, deposit growth rate of the bank is slow. If the depositors are less, not many people are coming to the bank to deposit money. Then what does the bank do? The bank issues CDs. Clear? The time period of CD ranges from 91 days to 1 year. So this you have to learn again. It varies from every debt money market instrument. Every instrument having a different time period, and this you have to make a chart, put it on your table, and you have to memorize it. Now the question, are CD and FD, the certificate of deposit and fixed deposit, are the same terms? No, they are not. There are a lot many differences. Let's discuss them. CDs are freely negotiable and FDs are not freely negotiable. CDs, they can be passed on to X, they can be passed on to Y, and they can come back to the same original person. But in case of FD, if it is in my name, it will have to be in my name. I will have to own it. On the maturity date, it is me who is going to the bank and to getting it. Okay, these days you don't need to go to the bank to get your FD. You just can happen it on app. But that app, your account number, it will be in my app, right? So it is not freely negotiable. If it is in my name, I only can get it redeemed even if I go personally to the bank or I do it through the app. Clear? So the point was that CD is freely negotiable and FD is not freely negotiable. CDs, they are issued for a period of 91 days, minimum to maximum 1 year. And in this case, the FDs, they are issued for a minimum period of 14 days and the maximum, there is no time limit. It can go on, but generally it is like, say, that it is fixed. Obviously, when you will go to deposit, you want to have a clearer picture now when it will mature. Okay, so as for writing purpose, we'll write that the minimum days is 14 and the maximum there is no limit. Clear? Third point is CDs, they are issued at a discount on the actual amount of the deposit held. They are issued at a discount. I have already explained you what does this mean. FDs, they are issued at the actual amount of the deposit held. है ना? Now, if you are going for the bank to fix the FD, say for 1 lakh, so how much will they charge from you? You will have to pay them 1 lakh. है ना? तभी आपको you can get that FD. If it is for 1 lakh, you have to initially deposit that 1 lakh, and maybe on maturity you may be getting 1,50,000 or 1,40,000 depending upon the rate of interest which is prevalent in the market, which depends from bank to bank and also from time to time, right? So this is how you will earn on the FD. But here CDs, they are issued at a discount. है ना? Similarly, supposingly you are doing it for 1 lakh rupees, you may get it for 90,000 and 10,000 will be your profit. So they are issued at discount, and FDs, they are not issued at discount at all. They are issued on the actual amount of deposit held. Is it clear? So FD and CD is not the same term. So here we come to the end of the article, Instruments of Money Market. I hope I have explained to you very nicely. If you have any doubts, please feel free to ask me in the comment section. Please like and subscribe to my channel. Thank you for watching. Stay safe, stay blessed.